Okay, let's make a start and see if you guys can hear all right. How's sound? Okay over here? It is good. Okay, you guys at the back, you want more? How's that? Is that better? Is that better? You know. How's that? Is that better? That's good. Okay, and you guys okay? Right. Okay, so hope this wasn't too bad. Anyway, it's gone. Unfortunately, I sort of have an apology to make because there's actually another assessment next week. That's the second online quiz, and I had to change the time of that test, the mid-semester test, because we've got 201 and 203 running in the same semester for the first time, and I didn't realize how close they were going to be for some reason. Obviously, I wasn't paying attention. But anyway, the details of the quiz, online quiz, the second online quiz, it will open on Tuesday, open at 6 a.m., and it'll be open all the way through till Friday, 6 p.m., so that's the time that it's open. There are 30 questions there, so they'll all be on a single page. You can just scroll up and down to see them. And there will be a time limit of 45 minutes for the quiz. And after that, there's this period which the system calls the grace period of 10 minutes, in which you can review what you've done, but you can't answer any further questions. And then at the end, you have to click on the submit to have it graded. The material covered in the online quiz are from the overview through to the end of the money market. So overview through to the end of the money market. So it doesn't include the bonds, which we're doing at the moment. Like the previous one, you're allowed 2 attempts, but if you want to do it twice, you have a 48-hour gap between the first and second attempt, so you need to do the first attempt early enough in that period to give yourself the 2 days and then have the second attempt. And if you do it twice, then the higher of the 2 scores from the 2 tests will become the score for that online quiz, and it's worth 3% of the final mark. Okay, so any question on that? Yeah, go ahead.
What's the point of the grace period
Well, the thing was that, I mean, the system has various ways of running it. You can run it. And one it is that when the time runs out, it just submits everything and it grades it for you, and that's the end of that. But when I talked to the student reps, and people just wanted some time to look at what they'd done. And so I explained this option that was there, and they asked that it be put in. So I did. Very easy to take it out, but it would have to be a class decision to take it out. So that's why it's there. So people can sort of look at what they did, and then they do have to submit it. The thing is, the advantage with the one is that when it shuts you down is that it will automatically submit it. And I did explain the trade-off to them, and that was accepted. That was fair. Okay. Any other questions? Okay, so let's review a little bit of what we did last time, which was actually now Tuesday. So we're in the section on the bond markets, and this is part of the capital markets. So the economic purpose of the capital markets is to raise funds for long-term productive investments. And there are, in actual fact, 3 different types of capital markets. There's the bond market, which we're studying at the moment. There's the mortgage market, which this particular textbook doesn't actually cover as a separate market, but both bonds and mortgages are a type of debt. The third one is the equity market, which we'll come to in the next topic after this one. And when you buy equities, you are actually buying a part ownership in the business that's issuing the equities. So in terms of the types of bonds that we study in this course, there are rather complicated bonds out there, but we only cover the most simple ones. We do talk a little bit about the options that they have and how that affects their interest rates, but we don't actually talk about any of the complicated bonds. All the bonds we talk about here are very simple. Then we went on to talk a little bit about some specific types of bonds, government bonds and then corporate bonds. The government bonds, again, they tend to be very simple in the way they work. They're either a zero coupon bond or if they're not a zero coupon bond, then they're simply a straight coupon bond, what we call a plain vanilla coupon bond. There's no reset of its interest rate, no options, no nothing. It's just plain, simple bond. Because the government tends to be the single largest issuer in any given market, that makes their bonds the most liquid bonds that there are in the market. And of course, because they are the government and have the power of taxation, then we consider that they're also free of default risk. So they're very low-risk bonds to hold. And a lot of corporations in the private sector, in the financial sector, hold these bonds specifically for liquidity purposes, for managing their liquidity. When we go to corporate bonds, you get a change in the type of investor as well as the type of the bond. First thing that's very obvious with a corporate bond is that the probability of default is higher. And with governments, you assume there's no default risk. Corporate bonds is always a probability of default. They tend to issue only what they need, and so the size of their issues is much smaller. Liquidity is lower. And then you also see that the types of investors in corporate bonds are different as well, and so the corporate bond market tends to be very, very illiquid compared to the government bonds. If we look at sort of an order of liquidity, if there's government issuing money market securities, that tends to be the most liquid debt market around. You also find that private sector money market securities tend to be very liquid. But then you take a step down when you go into the bonds. And so government bonds, although they're the most liquid of bonds, they're definitely much less liquid than a money market security. And then when you go to a corporate bond, you go down again in liquidity to a fairly illiquid market in pretty much most places in the world. Now, one of the other types of government bonds that we talked about was the inflation-adjusted bond. And that's because it's adjusted for inflation, what it does is instead of having a fixed par or fixed principal, fixed face value, the face value changes as inflation changes. So as inflation changes the value of the money, then the principal is changed automatically for you on a regular basis to compensate you for the loss of the purchasing power. And one of the good things this does in terms of providing a service to the financial markets, quite apart from their usefulness as an investment, is it allows us to see the real rate of return. Because remember back to the Fisher equation, there's a way of calculating the nominal return based on the real return that you want, plus your expected inflation. If you don't have to worry about inflation, all you have to do is ask for the real rate of return. And these inflation bonds, they allow you to see that rate, and that is quite useful for the for the financial markets. Now, I've had several people ask me about why the liquidity in the government bond markets has gone down, because we saw it also in the money market section, that the liquidity in the money markets has gone down. And I did dig up a bit of data about what's happening in that market. So here's some little bit of explanation about what's been happening, why this liquidity in these markets have gone down. Because basically what's happened is that people, instead of buying them for liquidity purposes and then trading them as they need to, there's a lot more investors which are buy and hold types of investors. So one of the big buy and hold investors we see in the world is the central banks, and particularly since the crisis period. So this is the U.S. Federal Reserve. So this is the assets they hold. So these are the ones that they bought themselves as part of their management of the economy. So there's three periods here, which they call the quantitative easing periods. QE 1, 2, 3, and 4 went back to back with no change. They just went straight on with the other. And what they were trying to do in this period was is that they were trying to flood the financial system with liquidity. Now, that's not necessarily a good thing, because you may remember this graph I showed you a while ago, about the inflation. When you get this is pretty dramatic, this one here, this is Germany, but even here you see these big spikes up in inflation in various countries. They're all, without exception, they're all due to this type of activity here where vast amounts of money is being created and pushed into the system, and because there's no corresponding goods or services there, simply what happens is the prices go up. And so if you think about where this graph starts and where it ends, here this is the beginning of crisis period, 2008. They had about 0.8 of a trillion, or about $800 billion. And then through these three quantitative periods, easing periods, like you can see that one, well, ramping up in QE2 and 4, they ended up at $4.4 trillion of assets here at this point. So this is not money that, these are not bonds that they've gone out and bought for liquidity purposes for themselves. They don't trade these things. They're simply buying them and pushing liquidity into the system. And so they become big buy and hold type investors. And if we look into the wider world, we see this around the world. So this is the, it's not a very good color, I'm afraid, but that's the way it goes. These are the 10 largest central banks in the world, and this is their holdings of securities that they bought on their own behalf to push liquidity into the system. So this goes back here to October 2006 to 2016, so it's a 10-year period, and it has marked in here various things like the financial crisis, European debt crisis, and the present. And so there's the banks: China, U.S., Japan, European Central Bank, Brazil, Switzerland, Saudi Arabia, United Kingdom, India, and Russia. So this is the assets held by the 10 largest central banks in the world. And you can see they start here about $6 trillion at this time, and over this 10-year period, they're up here at above $21 trillion. And again, this is not stuff that they're buying to trade. This is simply buy and hold. And so when they're buying this vast amounts of government bonds and government money market securities, they're essentially reducing the amount that is available to be traded. And so that's why we're seeing this reduction in the trading that is going on in these markets, simply as there is simply less there to trade. Now, they're not the only buy and hold investor that's come into this market, but certainly they're one of the biggest ones. So there's been some structural changes in the way that the economy's been working over the last sort of particularly eight or so years. That has reduced liquidity in these markets. And of course, as soon as you start reducing liquidity in a market like this, then for the other people who are in this market, their liquidity risk goes up, particularly for people who hold these things, financial institutions who hold them for liquidity purposes. Anyway, before we move on to our thing, anyone want to ask any questions about that? Yeah, go ahead.
Just wondering that since the Reserve Bank trying to buy back those government bonds, doesn't mean that the government is running surplus at the moment?
No, the thing is, with virtually every single bank in the world, maybe not all of them, but almost all of them, they're prohibited from buying government bonds at the time of issue. They have to always buy on the secondary market. So someone else is buying these things, and then in the secondary market, these reserve banks are buying them. So, if you look at the United States, they're running budget deficits, and so the government is still issuing bonds there. Australia, they have a deficit, they're issuing bonds, and this type of buying doesn't affect the budget surplus or deficit. Okay, any other questions? Right, okay, we'll move on. So, moving along from where we were, what are hybrid securities? What are hybrid securities? Anybody met hybrid securities? Have any idea what they are? Yep, go ahead.
So a hybrid security is basically where you can have the option to change it from, well, basically it's a security with two natures. Like that's kind of where you get the hybrid. So like in our case, I think we're looking at convertible. So convertible bonds where it would go from a bond, which is a debt structure, to like a common stock, which is ubiquitable.
Yeah. So key feature there is they start their life as debt, but they can convert to some other type of security. And the most common one we'll talk about, is that they can convert to common stock. So they're switching from being a debt to being an equity. And that's not the only type of conversion that you can have, but that is by far the most common one. Yeah. So why don't governments issue them?
That's obvious.
It's obvious. Good. Why is it obvious?
Apparently that if you can convert, just like you said, if you can convert the share of the government, you pretty much own the part of the government. That's definitely not allowed.
Yeah, you can't buy the government. Well, maybe you can, but at least but anyway, you're not supposed to be able to buy government. Do you have a separate point, or is that the same one?
Yeah.
Same point. Yeah, you can't buy shares in your government, so they just don't issue these things. So if we missed anything here, well, from an investor's point of view, usually they're structured in such a way that if the company, succeeds in the manner that it expects to, then these things will actually provide you with an overall a higher return than a straight bond. And when we talked about them in terms of the structure of interest rates or level of interest rates, when you have this type of option built in the bond, the coupon rate is lower. Okay, and you think, well, why would you have that thing? Why would you buy it with a lower coupon rate? And the idea is that if the company does well, then ultimately, over the long term, you'll get a higher return out of a convertible bond than a straight vanilla bond, even though initially your coupon rate is lower. Now, they can be a bit tricky to value because depending, particularly with those options in there, the value of the option that's embedded in the security depends on the price of the equity, if it's going to be converted to equity. And so they can be a bit tricky to value, but that can be done. And in New Zealand, they have this name, they're called capital notes, exactly the same thing. So when we look out who's investing in things, who are our major investors in bonds? Oh, very quiet. Oh, very quiet. What's that? You did. Oh. Okay. So the major investors in bonds, usually line up as suspects there. When you look at the long-term investments that are being made, when you want to say, well, who will invest in this stuff? You want to find investors with a long investment horizon. So usual ones, life insurance company, pensions, households in particular, foreign investors, and then these are collective investment vehicles that for private investors, so you can put your money into that if you don't want to buy bonds individually, and they will actually manage bond funds on their own. Now, one of the things about these is that when you look at the corporate bond market, particularly investors like households and even pension funds and life insurance companies, they're not buying them to trade. And so when you think about why the liquidity is lower in the corporate bond market, and it clearly is compared to the government bond market, one of the reasons it's so much lower is that the type of investment, type of investor here is different. They are not buying these things for liquidity purposes to manage liquidity. They're buying them for investment. And most of the times when you see a bond issue and you look at private investors, almost all of them at the time that they buy it intend to hold that bond through to maturity. Now, if the circumstances change, they may sell them, but most of them buy them for investment and intend to hold for the entire life. And so that makes that whole bond market much more illiquid compared to the government market. And when, last time when we looked at the New Zealand bond market, we saw like some bonds, they had no bids and no asks. And we looked at another one, I think it had a bid but no ask. Very little trading goes on in these markets. Now, we have talked in this section about the structure of interest rates, I think it was, about the bond ratings. And there is this legal definition of investment grade bond, which is BBB or higher. Sometimes that definition, is legal, is a legal definition, but also a number of the financial institutions are prohibited from engaging in investment in lower than investment grade bonds. The consequence of that is that when we look at the markets, the market for the investment grade bonds tends to be significantly more liquid than the junk bond grade. And again, that's simply to do with the fact that if you exclude a whole bunch of investors, particularly regulated institutions like life insurance companies, pension funds, and banks from this market, the whole market shrinks, gets smaller, and so liquidity goes down. Yep, go ahead.
So like you're saying, obviously there's large institutional investors above from buying those junk grade bonds. And if you're assuming that the majority of the market left to buy those junk grade bonds are smaller investors who don't have as much funds to diversify their credit risk, then who actually buys those junk grade bonds?
There's actually quite a reasonable size mutual, a mutual fund is. Okay, we haven't got mutual funds, but well, if you know what it is, okay. Lots of people who invest in that market will invest through a mutual fund, and they don't call them a junk bond fund. They'll call them something like a high yield fund. Sounds very nice, junk bond fund. And there's particularly in the United States, we have a big junk bond market. There's a significant business in the mutual fund industry providing mutual funds to people who don't want to buy individually, and they want someone else to do it for them. And of course, there's diversification in those things. There is a significant junk bond market there. Tend not to see. In fact, at one stage, Warren Buffett was a big buyer of junk bonds at one stage. But you don't often see a lot of individuals buying junk bonds.
It's not well diversified. It's actually by individual.
Oh yeah, I mean that's the basic. That's why people who want to invest in this type of market will tend to go with something like a mutual fund, and they may have hundreds or even thousands of bonds in there, and so they have diversification. And if you put your money with them, then you buy this diversification as part of the services they provide. Yeah.
Would there always be buyers though? Because if less people want to buy the junk bonds, then less demand, lower price, higher yields. So there'd be a risk.
Oh, there's definitely a risk premium because they're very risky bonds to start off with. Yeah, they're definitely very risky. In fact, the risk premium there is quite high. In fact, we don't have a junk bond market here, but to give an example, what can happen is I did see a bond on the New Zealand market a few years ago, and I showed it to the class when we had it. That was trading at a yield of 240%. Okay, that doesn't mean it's a good investment. It means it's really bad. There are even places that specialize in buying bonds of issuers who are in default. So you can buy these bonds at 240% interest rates, because often what happens in the initial part of the default is that they are actually oversold. And if you're patient, you can actually make a reasonable amount of money out of buying bonds that are in default when they go through the recovery phase. Anyway, there is this. Yeah. Any other questions on that? Okay. So bringing in the market, there's two basic ways to do it: competitive sale and negotiated sale. So what are these methods of bringing a bond to market? How do they differ? And then we'll go on to private placement. Oh, very quiet again. Okay, the two types of sale actually refer to how the investment bank is hired. Okay, so in most cases, most companies do not have the internal expertise to bring securities to market, so they hire an investment bank to do them. So there's two broad sections. There's a public sale, and then we're going to come to a private placement next. But in a public sale, basically they're going to make these bonds available to all anybody who wants them, anything ranging from institutions to private investors and the entire spectrum. So in a competitive sale, you actually call for bids from the underwriters, and the underwriters are the investment banks. So you basically say, I want to issue bonds. You put out a tender document, and then the investment banks will tender for that business. Say we'll do it for X amount of dollars or whatever it is. And in some places, like in the U.S., there are some issuers, like these public utilities, water, sewage, places like that. If they're going to have a bond issue, they're required by law to actually undertake competitive tender process. Now, this might seem to be a good thing, the competitive tender process, but the reality is that almost all of the very top investment banks will not even respond to a request for a competitive tender. They don't even try to get this business. And the reason is for them, from their point of view, this is less profitable business. They don't make as much money out of a competitive tender as they do with this other one. So the other one is where you actually go directly to the bank and you simply sit down and negotiate with them the terms of it. And of course, because you're only negotiating with one, then they can charge you more. But if it's underwritten, then they acquire the exclusive right to distribute it. Often, if it's very large, they'll actually invite other investment banks in, but they'll be like, if you look at a bond prospectus, if they do this, they'll say a lead underwriter and then a bunch of other ones. Yeah.
So just clarifying, so do the investment banks get a commission for finding buyers or something, or do they directly buy the stock?
Well, yeah. There's two ways of looking at it. One is that what they do is that they contract to buy all the securities, and they'll give them a specific price, and then they will on-sell those securities to the end investor. But usually those prices are set pretty clearly. And say, for example, that their fee was 5% of the value of it, and say there was 100 million coming out. They would pay $95 million for those bonds, and then they would sell them in the market for a total of 100 million. Now, the risk that they take is that they won't be able to sell that lot, and they'll be left with some. So they do buy the whole lot, and then they sell it on. And the difference between the thing is basically it's a bid-ask spread that they take in terms of how to make the money.
So you mean they're actually a dealer?
In fact, yes, they are a dealer. In fact, often where these do not have a secondary market of an exchange type, often the underwriter that undertakes the issue also then makes a secondary market. So they don't actually sell all of them, they'll actually keep some in order to continue to act as a dealer for that particular bond. Yeah, go ahead.
So if they choose to keep them, do they still have to sell them at that same price agreed under the bond issue contract earlier, or can they sell them at an inflated price later on?
Oh, once the issue is complete, and if they say to hold 2% for their dealership, then you are definitely in a secondary market situation, and you can charge whatever the market will stand. Okay.
So in terms of that, I'm guessing there's almost would there be bidding competitions between different investment banks, different investment banks or different dealers as to the quality of bonds that people want? So let's say there's a good quality bond that somebody wants to issue,
Yeah.
and these investment banks know that will sell really well. Will there be competition between the investment banks for that underwriting contract?
Okay, so that makes what's the difference between the two. So if you call for tenders, okay, that's a competitive sale. Now, with a negotiated sale, you actually only sit down and talk to one of them.
So you just have to choose exactly.
Yeah.
So you can't be okay, we're the underwriters.
Yeah. If you try to play the underwriters off with each other, you're really in the competitive sales situation, and some of them simply will not engage in that. In fact, most of the top ones, the very top ones, won't even try for that type of business. Any other questions? So we don't come to investment banks until very last topic in the course, but they do all the things, all the thing about designing securities, carry out all the legal work that is required to meet whatever requirements that the country has, makes its prospectus, does all the selling and everything, and they basically carry all that. And for that, that's why they earn their bid-ask spread on these things. Okay, what's a private placement of a bond? What's a private placement? Yeah, go ahead.
It's where a firm would, rather than issuing bonds to the public, they would issue them to just one a few large institutional investors.
Yeah, so a private placement, instead of selling to the public, they sell directly to a small number of large investors. I mean, in both cases, in this case as well as the other one, they will actually hire an investment bank to do that. But instead of sending out into the big market, the investment bank will go and find a few large investors that will buy the entire issue. Okay, so let's. These should be simple enough. We should just about be able to do these in our head. So what's the gross profit that an underwriter would make if it sold 10 million worth of bonds at par and paid the firm that sold the bonds at 97.25%? Okay, so this is how they make their gross profit. How much money would they earn off this issue? Oh, I think I heard that. Did someone say? 275,000. Yeah, it's 2.75%. 2.75% of 10 million, $275,000. So that's a gross profit. Out of that, of course, they'll have their expenses, but that's how they make their money. Now, one thing to think about this, if you're going to do corporate finance, or maybe might even come across this in 2.1 already, is if you think about the cost of the debt. Let's say that was $10 million issued and it was had a 6% coupon. The cost for the firm is not 6% because it has to pay 6% on the 10 million, but it only got 9.72 million actually taken in. So it's paying the 6%, which would be 600,000 per year on 9.725 million. But also when it comes to maturity, they have to pay the 10 million out. So although it may be a 6% bond from an investor's point of view, for the issuer, their cost of funds is actually above the stated coupon rate because they don't get the full value of the bond in at the start. So it pushes their cost of funds up. And yeah, there are other courses that will, particularly in the corporate finance courses, that will deal with the cost of funds and how if you can push, make your cost of funds look higher than what the investor earns. Okay, what about the other one? The other one should be simple as well. Dealer, buying and selling in the market, bought $100,000. That's a semi-government bond, 90%. Sold it 93%. How much do they make off that there? Should be able to work this out with a calculator. Yeah, well, 3%. Oh, come on. How much is that? Give me some dollars. 3,000. Yeah, it's $3,000. So on that trade, assuming that the bid-ask spread was that wide, they would make $3,000 on that trade, and of course that's a gross profit out of which any expenses must come. Now, private placements, they're pretty rare out here. The big private placement market is the U.S., and if any company in Australia and New Zealand undertakes a private placement, most of the time they'll do that by going to the U.S. market. So that U.S. will be issuing a U.S. bond somewhere. Now, one of the things about this is that the legislation around it is quite clear. Maximum of 35 investors. Okay, so it's fairly small. And the thing is that they often are unrated, and so these types of investors usually have on their staff people who can actually analyze the bonds and come to their own conclusions about what the appropriate coupon rate they should be getting is. And one of the things that we've seen, it's down here, and again, we talked about this in the very first section, is that when you make a secondary market, the primary market becomes more attractive. For a long time, up until 1990, there was no secondary market. If you bought a privately placed bond as an institutional investor, then you had that bond till the end of its life. Okay, there was no secondary market at all, but they pestered the SEC to allow trading. Now, the trading is quite limited, but even so, they allowed some trading, a relatively limited secondary market to be developed for the privately placed bonds. And as soon as they did that, then the primary market began to grow quite significantly. And as we've said before, once you've got a secondary market, that makes the primary market much more attractive. And the two things that the secondary market gives you is the ability to value pretty much straight away. You can look at the market and see what it's trading at if you have to value your portfolio for any reason. And the other thing, of course, it does provide you liquidity if you want to sell. So with those two things available, this market has grown significantly since that change back in almost 30 years ago now. So most of that. Okay, moving on to junk bonds. Any other questions before we go to junk bonds? Yeah, go ahead.
When you keep saying that the secondary market is make the primary market more attractive, do you mean more attractive to the issuer or more attractive to the buyer?
It's usually to the buyer. The buyer, because once they have it, I mean, the two key things the issuer is interested in is if they're holding it. Often they have to periodically value their portfolio, and how do you value it? If you have a secondary market, you go look at the market. And it provides liquidity. And so the existence of that secondary market attracts buyers. Okay? And so it makes the ability of the issuers to issue into a market much easier because there's more buyers there. So it's particularly good for the buyers. And of course, the issuers can take advantage of that when it gets bigger. Any other questions? Okay. Now, why would a firm prefer to issue a junk bond rather than obtain bank finance? Yeah, go ahead.
Well, if they issue a bond and it's considered a junk bond, I'm assuming they have a high risk or they're not, they have a high default risk. So if they went to the bank, then they charge a relatively high interest rate. So they might as well just put it on the bond market and the cost of borrowing might be low.
Okay, so the key point is that if you can issue on the junk bond market, that your cost of borrowing is less than going to bank. That's one point. Yeah, go ahead. You got another one?
I think you mentioned this concept before. It's kind of the direct financing and the indirect financing. Currently, the direct financing is way cheaper than the indirect financing.
Okay, that's the same point. Yep, it's cheaper. Yep. Anything else?
Would it also be if you did default on bonds, like if you compare defaulting on, like, let's say 10,000 junk bonds that have been issued to 5,000 different investors or something like that, instead of defaulting on a loan to a bank. If you default on a loan to a bank, you're defaulting on a debt security to a large institution that's got a lot of funds to basically claim what you've defaulted on.
All right.
Whereas if you've split up your debts into a whole lot of small categories, the pain of defaulting on your debt is a little bit less, and so people are less likely to come after you.
Okay. Well, I actually hadn't thought of that, but I suppose that's a fair point, that if you owe the bank money, then yeah, they got plenty of lawyers to come after you. But if you got 1,000 investors, they got to get together to chase you. Fair point. Interesting. I hadn't thought of that. Yeah, go ahead.
Would it be because the junk bonds would be unsecured?
Yeah, they typically are unsecured.
As opposed to a loan where if you get a loan on a capital asset or something with the bank could require security on that.
Okay, so there's a key point that if you go to a bank, they're going to require security, whereas with a bond, you're typically unsecured. And of course, in terms of recovery, if you're secured, the bank can get after you much easier. Okay, so that's another point. Any other points? Anything else? Okay, let's see if we missed anything. It's actually over here. Yeah, that's the primary one, is this lowered cost of borrowing. And that's the main thing, is if you're going to do it. That's your big one. Maybe not having the lawyers after you might be an interesting point. I didn't know about that one. I hadn't thought about that one, but it's worth thinking about. Now, when we look back at initially, there was almost no primary market for these things. If a bond was a junk bond, it had started out as an investment-grade bond. The company had fallen upon hard times. Their bond got downgraded, and it was a junk bond. Now, again, we talked about this, secondary market. This particular company, Drexel Burnham Lambert, they actually started a secondary market. They stepped into the market and they created a market. They became dealers. And as soon as they did that, then, of course, if you can trade in a dealer market, you can trade, even though there may be big bid-ask spread, you can trade with a dealer straight away. Then we saw this market begin to take off, and there were a lot of issuers came into the market that simply were not there before. And so, because it's cheaper for them, we saw this bond market take off. But again, these things are not without risk. If you look back in the 1980s, like 1980s when this started, there was a long period of economic expansion. And so initially, these junk bonds had quite low default rates. But again, they had high yields, high coupon rates. They looked very attractive, but ultimately that risk came back to bite people, and then the actual company that made the secondary market itself collapsed, even though the total market did not collapse, and the defaults on these bonds actually went up. So the risks are there, and of course the risk changes with the economic conditions. When the economic conditions are good, which is when they started that secondary market, they looked very attractive because the default rates were low. But of course, as soon as economy heads downhill, defaults go up, and that risk, which was in one sense always there, comes out and can be seen. Right. How are we going for time? I think I'll skip that last set of questions. Credit enhancements. Okay. Why are financial guarantees becoming increasingly important in financial markets? They're certainly important in the U.S. and certainly important throughout the world. So what are these things, and why are they important? What is a credit enhancement, and why is it important? Nobody knows? Okay. Well, they come in various forms, but the two main ones are a type of insurance and a line of credit. So the main one that most people talk about, it's a type of insurance. You buy an insurance that if you as the issuer default, then the insurer takes over from you and pays the interest and the principal after the point of default. And when you think about what's actually happening there, we've seen this type of thing before, is that if you have a highly rated insurer, say an insurer has a AA rating, but the issuer has, of the bond, say has something like a BB, so it's down in the junk bond part of the world. By buying an insurance from a AAA or AA issuer of insurance, they move their bond up into the investment grade. And so it really, the quality of the bond now depends on the quality of the insurance company rather than on the quality of the issuer of the bond. Now, that's not necessarily get out of jail free card, because we have seen at times when the insurance company or the guarantor itself suffers a downgrade, and then simultaneously every bond that they have guaranteed will suffer a downgrade at exactly the same time. And we saw that in the financial crisis, where some of these issuers had guaranteed thousands of bonds, and the entire batch of, say, 1,000 bonds that they guaranteed, they all suffered a simultaneous downgrade at the same time. But this is what it is. And you can see why that might be important if for example, if you want to if you want to access the investment grade bond market, but you yourself as an issuer do not have an investment rating yourself, you can simply go out. In one sense, you can go and buy an investment grading from one of these issuers, like an insurance company. Now, the other thing that you can get is that you can get a letter of credit. This tends to be much more used in the commercial paper market, but sometimes you'll see this in the bond market as well. So the guarantees lowers the default risk. Actually, since you can't see my final question there, but interesting question, because this doesn't come for free. Okay, the issuer has to pay for the insurance. So the question is, how does this work? Because this does, in one sense, when you start thinking about this, you think this shouldn't work. So how does a lower coupon? Okay, that's the, if you go out and you pay an issuer of insurance for, say, a AA rating, and you were, say, BB to start with, obviously you get a lower coupon. But you have to buy that. You have to pay that insurance fee. So how does a lower coupon plus this fee result in a gain for the issuer? Where does the gain come from? I've got two competitors. We'll go for you first.
So, I mean, there could be difference in the coupon and fee, but assuming they directly cancel each other out, the net gain would come from your ability to access funds, access a greater range of funds by upgrading the quality of your bond. So if you weren't previously an investment grade firm and you can issue an investment grade bond, you will get funds you would never have been able to get before as a result of having this insurance.
Okay, so a point there is that you might be able to issue a bond, whereas before you may not be even able to issue the bond at all, or either if you could, you may not get the funds. So this might give you full access to the funds you want, whereas if you were stuck down that junk grade, you may not get the funds. Okay, that your point? Okay, good point. That was your point as well?
I was going to bring that up, but also it's the whole thing of the effectiveness of the insurance in terms of bringing down the perceived default risk, and therefore bringing down the default premium that investors would be requiring. And so, we've got the lower coupon.
Okay, so yeah, I mean that's sort of why the coupon comes down. But again, if you think about the insurance company, they obviously got to price this right for themselves.
Yeah, that's the thing. They effectively almost lump themselves in with the buyer of the bond.
Yeah.
They're putting their name on it.
Yeah.
And they're putting their money on it as well.
Yeah.
In theory, it should cancel out because the risk that you don't pay to investors, you should be paying to the insurance company.
Yeah. So where's the gain come from? Okay. Doesn't smell right, does it? Okay. I mean, this works in the real world. Okay. So there's something going on here. Now, probably the I'm not just going to, shouldn't say most obvious because it's not always, but excuse myself. The most obvious place that it comes from is that because you're moving up into a more liquid market, your liquidity premium is lower. Okay, and that's where the biggest chunk of the gain comes from, is in the lower liquidity premium. All the default stuff is handled in, when you're talking about they exactly offset each other and there's no gain there. That's actually right. There's no gain there because the insurance company's got to pick up that and make you pay for it. And where the gain comes from is in a lower liquidity risk. Make sense? Okay, well, I'm going to stop at that point, but don't run away. Don't run away. Just put this thing on mute for a minute.